It's time for the Money Puzzle Podcast. With good conversations and realistic solutions to the money puzzles we all face every day. I'm your host, financial advisor, chartered financial consultant, and president of Edgen Insurance and Financial, Robert Edgen. Now let's get this show started. Hi there, hello, and welcome to the Money Puzzle Podcast. I am Robert Edgen, and I'll be your guide for the ride for the next few minutes. Each week, we look at a different piece of the money puzzle and practical ways to solve it so you can have the financial confidence you deserve and the future that you dream of. Now, this is episode number 23, and today we are kicking off Liam, which happens to be one of my favorite months of the year. No, we're not celebrating Liam Neeson or Liam Hemsworth. Every September, all across these great United States of ours, it's Life Insurance Awareness Month. Hooray! Huzzah! I actually don't know what huzzah means, but I think it's what they used to say back in medieval times, right after they got their life insurance set up for their families before heading off to pillage the next village over. So huzzah. Now, why do we have a Life Insurance Awareness Month? Who needs life insurance? And no, not everyone does. So I'm not going to be the guy who tells you that everybody, including you, needs life insurance. But if you do, how much do you need? What kinds are there? How does it work? All that and more on today's episode. So I'm really excited to get into that conversation, but I thought we'd take a minute to look at some news. Today's article comes from Reuters, and the headline reads, "Stowaway falls from plane over London, narrowly missing sunbather." The body of a suspected stowaway fell hundreds of meters from a plane flying over southwest London, landing in the garden of a man's home, just missing him as he sunbathed. Police believe the man fell into the property in Clapham from the landing compartment of a Kenya Airways plane as it lowered its wheels on the approach to Heathrow. A bag, water, and some food were all found in the landing gear compartment. Kenya Airways said the 4,250-mile trip from Nairobi to Heathrow takes about 9 hours. Stowaways have previously landed in trees and on top of shops in London after falling on the approach to Heathrow as well. I cannot believe that this really still happens. How the heck do you decide to sneak into the landing gear of a plane, and where the heck are all of the airport people when you are approaching the plane and climbing into the wheels? I just don't get it. This is crazy to me. It is sad that someone died doing this, or apparently multiple people, but what the heck do you expect? It would be easier just to buy the largest suitcase you could, jump inside of that, and pay the extra $50 for the heavy bag fee. But I guess people will do what they got to do to try and get away from where they don't want to be. Crazy. If you'd like to read the rest of that article, I've got the link to the story in our show notes down below the video, so make sure that you check it out. This also seems like a good foray into the conversation of life insurance, so let's go ahead and get to our hot topic for the week. All right, so it's Life Insurance Awareness Month. What the heck does that mean, and why should you care? Well, believe it or not, for most people, life insurance is one of the foundational pieces of a good financial plan. But why? Well, that, my friends, is a great question. If you're married and you have a family, life insurance helps you keep the promises that you've made and do the things for your family that you said you would do, even if you're not there to do it. It provides the income you can no longer provide. It pays for the summer camps and the piano lessons that you're no longer there to pay for. And it helps fund the retirement plan for your spouse that you're no longer there to fund because you promise to stick with them and be with them and help them. And this allows you to keep that promise and help them retire, even if you're not there to help make those contributions. So one of the reasons life insurance is important is if people rely on you financially. If you're the breadwinner, life insurance is there to replace your income. It puts a financial value on your human life. And here in a few minutes, you'll be surprised to find out at how much you're actually worth. But what if you're not the primary earner in your home? What if you are a stay-at-home parent? What if you're not married or you don't even have kids? Well, if you're a stay-at-home mom or dad, life insurance would cover the costs of the work that you do for free, which is a lot. Raising a family, taking care of a home, chauffeuring the kids, tutoring, cooking, cleaning, and everything else that goes with being a stay-at-home mom or dad is very expensive if you actually have to pay for it. There's a couple of different websites. In fact, I'm putting a link down below that shows the most recent studies on what it costs to replace a stay-at-home parent. The estimates are somewhere between $90,000 and $160,000 per year. So you definitely have a financial value. The life insurance for a stay-at-home parent would be used to provide the funds to either hire out that work if a stay-at-home parent dies, or to provide some extra income to the breadwinner so that maybe they can work less and then spend some more of their time at home with the kids doing those things themselves. Now, if you're divorced, life insurance covers the child support your kids need if you're not there to pay for it. If you've got a mortgage on your home, it makes those payments or pays it off so that your family can stay in the house. They don't have to sell the house, move in with parents, change schools, or be forced to move. If you own a business, it pays off your debts and it covers the cost of hiring a replacement for you so the business doesn't go out of business. Typically, if you owe someone or you love someone, life insurance should be a part of your financial puzzle that you need to figure out. But even if you don't owe anyone or love anyone, life insurance can still be important for a few reasons. Life insurance actually has some amazing tax benefits that can be used to build your own wealth. It can be used as an asset class. It's used by people who want to act as their own bank. It can add some tax-free money to retirement, or it can even help cover some long-term care costs. Life insurance, it does a lot, and it can do a lot for people, both with families and without. We'll get into that side of thing over the next few weeks. Now, I've been in this business for long enough to deliver quite a few life insurance checks. It's never easy sitting down with a family or a spouse after they've lost someone that's close to them that they love. But I have to say, from my personal experience, it makes an incredible difference when the family knows that they are going to be okay financially. Life insurance prevents a life tragedy from becoming a financial tragedy, which then compounds the life tragedy. It's if they know that they're going to have the money to keep on living, that they're not going to have to sell the house, that they're not going to have to make the kids change schools, it makes life a little bit more bearable when they're dealing with an extremely difficult time. According to the nonprofit group Life Happens, 1/3 of all households would have an immediate problem paying their bills if the primary earner died unexpectedly. Unexpectedly. To me, that sounds like had they been expecting it, they would have prepared for it. Well, unfortunately, the majority of people who died last year were probably not expecting it, but we all should be. Maybe not this year, hopefully not next year, hopefully not until we're older than dirt after living an awesome life full of love and happiness. But all of us should expect that it will happen to us someday, so we should prepare for it. 71% of people say that they know they should have life insurance, but 40% have done nothing about it. They don't have enough or they don't have any because they are either unsure about what type they should buy or how much they should get. Well, I think we can help with both of those things today, like right now. There's really only two kinds of life insurance: term insurance and permanent insurance. Now, sure, there are variations of both of those, but you really only need to know for now that there are those two types so you can figure out which kind is right for you. Let's break them down real quick so that you know how they work. Now, usually when I'm doing this with clients, we've got a pen and paper and we're sketching some things out. So we'll see how we do using nothing but the power of words. Good luck to us all. No, I'm just joking. I think I got this. Let's start with term life insurance because it's very simple and straightforward. It's called term insurance because the policy is set to last for a certain amount of time, a certain term, like 10 or 20 years. Term life is sometimes called pure life insurance because during the term of years, As long as you pay your premiums, and if you happen to die, the insurance company is going to pay your beneficiary the death benefit. Your life insurance contract is locked in for the coverage amount that you chose, and then the price that goes along with it, and the insurance company isn't allowed to change it during your term. So if you've got a 20-year term, your insurance contract is guaranteed for 20 years. That's really what we're talking about with term insurance, is how long of a term or time frame are you locking it in or guaranteeing that it won't change. You'll know what the price is, you'll know what the coverage is, and if you've got a 20-year term, that's the way it'll stay for 20 years. Now, with all life insurance, the older you are when you purchase it, the more your life insurance is going to cost, because in theory, every year you are 1 year closer to death. Now, I know that any of us could go at any time. I could be struck by lightning while I'm sitting here filming. But statistically speaking, the older you are, the greater your odds are of dying in a given year. So your life insurance gets more expensive as you get older because the insurance company has a bigger chance of paying out on your policy each year as you age. Life insurance have teams of actuaries, which are like CPAs with less personality. And they use a bunch of research and formulas that pretty much tells them when everyone is going to die. Now, they don't know specifically for you or specifically for me, but they do know that out of every 1,000 customers they have that are your age and have similar risks as you, how many will die next year, and the year after that, and the year after that, and so on and so forth. And so, as more and more people die later in life at certain ages, the insurance companies are able to get a pretty good picture of how much the life insurance should cost for you at any given age. What life insurance companies do with term insurance is pretty cool. Instead of making you pay a different amount every year as you get older, they look at what each year's price would be for whatever term you choose. So let's say 20 years. And then they have you pay the average price for that entire time. That way you know exactly how much you'll be paying for the entire term. You don't have to worry about the price going up every single year as you get a year older. Now, once you get to the end of your term, your lock and your guarantees, they all go away and things change like the price. Now, most people just go out and get a new life insurance policy after their term ends, or hopefully before their term insurance ends. But an insurance company will actually let you keep your term insurance past your term period if you want to. However, the rates now change every single year, which means that you're 20 years older, and based on what we just talked about with the pricing, you can expect your price to jump up probably 10 to 20 times what you were paying while your price was locked in based on your new age. Now, most people only keep a term to the end of that policy term. If they buy a 10-year policy, they keep it for 10 years. They buy a 20-year, they keep it for 20 years. If they have some kind of serious health issue and they probably won't live much longer, that's about the only time that we see people keep their existing term coverage past the end of the term. Otherwise, it's very expensive to keep a term policy going, and it's usually better to just go get a new policy where your prices can be averaged out over a long period of time. Now, the other type of life insurance is broadly referred to as permanent insurance, even though quite a bit of it isn't actually permanent. If a policy accumulates some type of cash within the policy, that puts it into the permanent category. Now, with a permanent policy, they actually start off working just like the 20-year term policy that we just talked about, except instead of just adding up the yearly prices for 20 years and dividing it by 20 and having you pay the average, the costs get added up for each year until you reach age 100 or 120, depending on the policy. And then that amount is divided by however many years you've got left between your age and age 100. and then that's the price. So it's dividing out a lot more years, which include those later years in life, which get to be a lot more expensive. So it's kind of like your 20-year policy where you pay more than the actual cost at the beginning, but you pay less than the actual costs in the end. But there's something extra that helps bring the price down in a permanent life insurance policy, and those are interest earnings. Because you're going to be paying quite a bit more than the actual costs at first, and you're going to be paying for a very long time through age 100 or 120 sometimes, the insurance company actually invests a part of your payment, or they pay you a set interest amount or interest rate on the extra premiums that are going into the policy. There are some kinds of policies that let you choose your investments. There are others where they just pay you a set rate. That doesn't really matter for now. What matters is the concept. So if an insurance company is going to give you a 5% interest rate on that extra part of your payment, that money will grow for you. And that means that your monthly payment can be lower based on how much money it's going to earn. The money that it earns is going to help you pay for the premiums later on in life. So hopefully that makes sense, because you can't tell me if it doesn't right now. I've also got some great links in the show notes that will break down the differences as well and do some comparisons in case you want to see it instead of just hearing it. Now, permanent life insurance policies build up that cash inside so that you can lock in your payment for longer. Technically speaking, inside of the permanent life insurance policy, the cost of the life insurance still goes up every single year, but the cash that's inside that's building is used to help pay for those extra premiums later in life when they become so expensive for a year of coverage that you'd probably never keep paying it on your own. So permanent insurance will cost significantly more than a term policy when you start it, because it's taking into account your costs at age 80 and 85 and 90 and 95. And they've got to collect enough premiums and have enough cash build up inside of your policy to cover those costs later in your life so that you don't have to come up with the extra payments yourself. Term life will be much cheaper when you first buy it because they're only looking at a very finite time in your life, 10 years or 20 years or whatever term period that you choose. So they don't have to account for the age 80 and 85 and 90 when they're looking at those prices. But in the long run, if you need coverage when you're older, which is when most of us die, term insurance will end up costing you more later. So one of them is cheaper in the short term. One of them is cheaper in the long term. Okay, so we've talked about why people might need life insurance. We went over the two basic types of life insurance and how they work. Now, the three questions that you need to answer are this. Number one, do you need life insurance? If so, number two, how much life insurance do you need? And then three, what kind of life insurance is right for you? So, do you have people who rely on you financially? Are there debts or a mortgage that would need to be paid off when you die? Would your business need financial help? In general, if you love someone or owe someone, you probably need life insurance. The next question, if you do need it, how much do you need? Now, this will be a little bit different for everyone, but I want to give you three quick ways to answer this question. First, there's a life insurance formula that's been around longer than I've been in the business, so long enough. And you might have heard it, but it goes like this. It says you need to have 10 to 12 times your annual income in life insurance. The thinking is that if you add up all of your debts that would need to be paid off, along with how much money your spouse or your family would need each month to replace your income, it typically adds up to that 10 to 12 times your annual pay. Now, personally, I believe the 12 times amount is the more appropriate amount, but 10 times makes for easier math. So if you make $75,000 a year, you need $750,000 in life insurance. If you make $50,000 per year, you need $500,000. Cool little math tip for you. If you are multiplying something by 10, just put another zero on the end, and that's your answer. Voila, it's that simple. Here's another way to check, and it's called the DIME method, D-I-M-E. The D stands for debts. which are your car loans, student loans, credit cards, everything other than your mortgage that would need to be paid off if you died. The I is for income. How much money would your family need each month to pay their bills? Here's another little pro tip for you. Subtract out the monthly payments for all of the debts that we just listed under the D, and because those would be paid off, and subtract out your monthly mortgage payment because we're going to deal with that next. But you've still got to have money for food and insurance and kid stuff and living life. So if it's another $4,000 a month, that's $48,000 a year. And if they would need it for 10 years, that's $480,000 that they would need. There's that cool math tip for you again. The M is for your mortgage. If you were going to write a check and pay off your mortgage, how big would that check need to be? What's your mortgage balance? And then finally, the E is for education. Now, some parents want to pay for college, some do not. I'll leave that up to you whether you do or do not. But if it is in your plans to pay for your kids' college or a portion of their college, then you probably want to make sure that it still happens even if you pass away and can't be there to do it. So add in the money for your kids' schooling. I would recommend at least $100,000 per kid because college is expensive. Add up those four categories, the D, I, M, and E, and that's how much life insurance you should have. And then there's one more way, which is actually a link that I'm going to put into the show notes, but I'll tell you about it real quick. The nonprofit group Life Happens has an excellent little calculator, one of the best that I've seen, right on their website that will let you plug in your own specifics. And then in about 3 to 4 minutes, it will tell you the exact amount down to the dollar that you should consider having for your own personal needs without any life insurance person telling you how much coverage it is or trying to sell you something. So go to lifehappens.org. Up on the top toolbar, right in the middle, it says calculators. Hover on that, and the very first calculator says life insurance needs. You can also get a great education on that site as well, and even watch a really cool video from Brooke Shields, who is this year's Liam's spokesperson. Every year, a different celebrity acts as the spokesperson for Life Insurance Awareness Month, and they tell their own personal story of how life insurance changed their life. It's definitely worth checking out. Brooke does a great job for us this year. All right, so you just figured out how much life insurance you need. Now we've just got one more thing to squeeze into this show, and that's which kind is right for you. Which kind of policy should you buy? We now know how both the term insurance and the permanent insurance policies work, but how do you pick which type? This seems like a great time to share with you Robert's 3 rules for life insurance, which go like this. Rule number 1, make sure you have the right amount of coverage or protection for your family. If you just found out that you need $600,000 worth of coverage and you've only got the $150,000 policy that your work provides, it's better than nothing, but you're going to end up leaving the people you love holding the bag and dealing with the people that you owe. So make sure you've got the right amount of coverage, rule number 1. Rule number 2, make sure it fits in the family budget. If you want a policy that lasts for 30 years, but you can only afford one that lasts for 15, pick the one that goes for 15. You need to be able to fit it into the monthly budget. If you don't, it's just a matter of time before you fall behind and quit making payments, you lose your coverage, and then you're back to violating rule number 1. You can always change the type of policy that you have later as your budget changes. We'll actually talk about that next week as well. Rule number 3, worry about the bells and whistles. There's a lot of cool things that you can do with life insurance that we'll be talking about, but how long does it last? Can you pay it off early? Does it build up cash value? Can it be a part of your retirement plan? None of the bells and whistles matter if you violate rules 1 or 2. So the right kind of policy to get is the kind you can afford. In general, if you're buying life insurance for something specific, like to pay off a mortgage or replace your income while your kids are young and your spouse is staying at home, you would pick a term insurance where the number of years match up with that need. If you've got 20 years left on your mortgage, you pick it for 20 years. If you've got 10 years left of your kids being in the house, a 10-year term might work. If you want life insurance to last the rest of your life, no matter how long that is, or you want to lock it in while you're younger so that you don't have to think about it when you're older, then a permanent policy would be the right choice. In reality, most people probably need some of both. A term insurance policy with a lot of coverage to take care of things, to protect the family that, for things that will go away, like the mortgage and the kids, things like that. And then a permanent policy that provides an income for your spouse later in life or provides a legacy when you go for the kids. Those are permanent policies or reasons to get permanent policies. Now, we'll be spending a little more time talking about some interesting things with life insurance over Liam, but no matter how you slice it, life insurance is something that you need to figure out for your financial plan, your money puzzle, and your family. Hopefully now you understand a little bit more about the different kinds of policies and how they work. You know how to check and see if you've got enough coverage or figure out how much you should have. And you know Robert's 3 rules of life insurance. Get the right amount, make sure it fits the family budget, and then worry about the type of coverage and the bells and whistles. Next week, we're going to talk about some different things you need to know about qualifying for life insurance. We'll also talk about what you might expect to pay for life insurance, and we'll talk about some of those bells and whistles that can be added on or are already included in most life insurance policies. We'll also look at work life insurance and compare that to buying life insurance on your own from a life insurance company. All right, that's it for this week. I hope you got some value from the show. If you did, please share us with others. Send this link on to somebody who needs to hear this message about life insurance. Also, go give us a rating on whatever app you happen to listen to. Go on to YouTube and like the videos, and make sure that you subscribe so that you don't miss any future shows. If you've got any of your own money puzzle questions that you need help with, email your questions to questions@yourmoneypuzzle.com. Otherwise, until next week, be safe, have some fun, and go do something to help improve or solve your money puzzle. Your future self will thank you for it. Talk to you soon.
Registered representative of and securities offered through Securities Management and Research, Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning, Inc. Edgen Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.